If the foundation is sound, the building will be well constructed, it is said. Additionally, I'll fortify your stock market foundation so you can generate a sizable profit and establish your own financial success. While the stock market is sometimes shown in movies as being dangerous, some friends seem to be making a lot of money with it. Family members, on the other hand, suggest against it. In addition, you might discover that the explanation of the stock market in school or college was not entirely accurate if you studied commerce. It is normal to feel confused and anxious in these situations. However, after watching this video, all of your confusion will be cleared, and you'll find out how and where to enter the stock market. Let's start with a fun fact to pique your interest. If 40 years ago, someone in your family had invested $10,000 in WIPRO shares today, 40 years later, it would be $700 crore. This illustrates the potential of the stock market. Now, you might be thinking, who had $10,000 back then? Even if someone had invested $1,000, it would be $70 crore today. If there was at least $100 invested, that would also become $7 crore. This example demonstrates the potential of the stock market. However, don't misunderstand. I'm not urging you to enter the market hastily. There are risks in the market, and for every profit, there is a potential for loss as well. There are stocks where an investment of $700 crore could now be worth only $10,000. The market can bring significant profits, but also substantial losses. My goal is to guide you on minimizing losses and maximizing profits. The first question we'll discuss is whether the share market is risky, and if so, how much. The second question pertains to the expected returns from the market. Thirdly, we'll cover how much money you'll need to start. Whether you're a beginner or a student, can you start with your pocket money? Fourthly, we'll discuss the ease or difficulty of entering the market and what a demat and trading account are. Fifthly, we'll explore why the market has a bad reputation and why family members in films often create fear around it. We'll analyze if the market is genuinely dangerous and whether you should stay away from it. Sixthly, we'll address a common question. Can you enter the market even if you're not from a commerce background, such as engineering or arts? 7. We'll delve into how the market works, why share prices go up and down, and the basis for selecting shares. Finally, in the 8th section, we'll explore if in-depth knowledge is required, and which books, courses, blogs, and magazines can aid in building a career in the stock market. Now let's begin with the first question. Is the share market risky? I'll illustrate this with a basic example. Essentially, when you buy a share, you are purchasing a small part of that company, becoming a co-owner of sorts. Imagine you invest in a friend's or relative's business. And if that business doesn't do well, your money is at risk. Similarly, investing in the stock market involves risks. You invest in prominent companies, and if the company fails, then your money will also fail. If the company shows very good growth, then your money will also grow. It's just like investing in a family member or friend's business, hoping for a share of the profit if the business grows. If it incurs losses, you'll take the loss and won't have to pay any interest. In the share market, you don't earn interest because it's not a loan. Many companies face losses and drown. But look at Eicher Motors. In the past 7 to 8 years, they have significantly increased the sales of bullet bikes. Similarly, many shares have grown multiple times, meaning Rs1 has grown 10x, 20x times, which has grown 10x times in 10 years. There are more shares like these that can give you a 10x times return in 5 to 6 years. It's definitely risky, and that's why the returns are high. We'll discuss risk mitigation methods in this video to lower the risk. The question of how much return you can expect from investing in the share market is not a fixed criterion, as there are many shares that don't grow a single rupee but instead fall. However, it is advisable to invest in a portfolio of stocks, at least 8 to 10 companies, to ensure that if 1 to 2 companies perform poorly or fail, you don't lose all your money. In India's high-growth economy, you can expect 18% to 20% return in the long run, at least 5 years with good stock picking. Compared to FDs, it is 3x times more and 2x times more compared to gold and real estate. To start investing in the share market, consider which types of shares you are investing in and how consistently they give returns. For example, starting with $1,000 per month, increase it by 15% each year, starting with $12,000. As your income grows, transition from student life to earning member or with promotions and salary increases, you can continue investing for 25 years with a 15% annual increment. Even if you get only a 15% return on investment, after 25 years you will have $1 crore. To calculate the amount you will make after each year, use Insight Calculator to determine if you started with $2,000 or $3,000. Now let's discuss the fourth question. How difficult or easy is it to start? And what is the process? The process is very simple. You only need documents, PAN card, and a bank account. If you don't have these, open them. Nowadays, all processes are online. Many online discount brokers facilitate the process. In 3 to 4 days, without any physical paperwork, your account will be opened online and you can start trading. The account opening cost is $300, and the brokerage or commission is 0 to none if you are investing. If you are buying and holding shares or selling them after 2-3 days or more, you don't have to pay any commissions. It's almost free, with some nominal government taxes that are less than 0.1%. So go to the description, open an account, and after 4 days, you can begin investing. The fifth question is, if everything is so good, why does the share market have a bad name? Why do people fear it? The simple reason is a mindset problem. When we buy property, do we think in 4 days the price will be doubled, and I will sell it? When someone buys gold, they pass it on for generations, but never sell it. No one thinks, let's buy today. Then after 1 month, when the price increases, I will sell it. We give property and gold the time to increase. But if your friends tell you to come to the share market and share stories of making $40,000 in 1 day or doubling their money in 2 months, it creates wrong expectations. Some people enter with the mindset of becoming rich overnight. You can either become rich overnight through a lottery or by gambling somewhere. And if you are lucky, it can happen. If you play the share market as a gamble without understanding the company you are becoming an owner of, not researching the manager, and not knowing the business model, then you will likely incur losses. So in the rush to make money, people often buy $1 or $2 penny stocks without thoroughly assessing the company's worth. The idea that doubling money from 1 to 2 might happen is unlikely because the company may not be worth it. In the stock market, it's crucial not to expect overnight wealth. A realistic return is around 18% to 20%, with anything higher considered a bonus. This translates to doubling your money approximately every 4 years, offering better returns than bank FDs. Regardless of your educational background, anyone can enter the stock market. 2 examples highlight that even 10-year-old kids outperform chartered accountants in selecting stocks based on their familiarity and satisfaction with the products. Similarly, if you're an engineer, focus on companies related to your field or select businesses you can judge well. This is it for today, everyone. I hope you find the video interesting and informative. So do like and share the video with your friends, and don't forget to subscribe our channel and hit the bell icon to stay tuned with us. See you soon in the upcoming videos.